Hi everyone, and welcome to this, well, it's afternoon here in the UK for this webinar, and we are storm lashed. That's the only description I can give you. I don't think I've ever seen so much rain, fog, a bit of, I think we've got a bit of sleet as well. We are really being attacked at all sides by the elements. It's actually rather dramatic and rather beautiful. But anyway, wherever you are in the world, welcome. I've just been waiting for the recording, which I can see David has started. And as usual, before we proceed, can I just draw your attention to the disclaimer that you should be able to see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. And as usual, I am joined by my husband and fellow trading partner in crime, who's actually, we're not sitting opposite each other. We've got separate desks where we're not where we usually are. And so if this is the first time you're joining us, you're very welcome, of course. And these sessions that are now the afternoon sessions, you will have had an email which basically has restructured the two webinars that we're doing at the moment, which is basically workout at Tuesday afternoon and Thursday morning. As I said, that's London time. And the Tuesday one at the moment, what we're doing is volume price analysis as it is applied to the indices, some commodities, and the stock market. But from a trading perspective, what we are looking to do certainly in the new year is we are then going to split this off into two, where we will be doing VPA as it can be applied to trading, day trading, short-term trading, and then VPA as it can be applied to investing, because I do have a lot of emails from investors who use the methodology as it is explained in the book that you can see in front of you. It's although this particular book, it covers the methodology, but it has other markets as well, but predominantly stocks, and it now has a companion book where we have examples of the methodology, and it's really to explain how we can use this fantastic methodology using price action and volume to determine where the market is going next, what signals we can see on the chart for re-entry, maybe for entry, for exit. It is so powerful. I'm just going to pass over to David so he can say hello, and then I'm going to get on my soapbox. So I'll give David a chance to have a word in Edgeway before I go on my rant.
Hi everybody, hopefully you can hear me loud and clear. I can't hear myself in my headset, and I'll sort that out in a minute. That's better. There we are. I'll turn myself up a bit. Great stuff. I can't wait for Anna to get on her soapbox. If this is your first time with us, very warm welcome. We focus on, in terms of platform, we focus on the NinjaTrader platform, but VPA as a methodology is applicable to any trading platform. All you need is volume and price, and that's what it comes down to. Just as a very quick aside, Anna mentions the two books there. What we are doing right now, literally over the next, and we have started already, and they will be going up the next few days. If you haven't invested in these individually, we are actually bundling them together in complete package of books, of a library, if you like, of Forex trading books and also stock trading books based around the volume price analysis methodology. So they will be going up. So you should see those in the next few days, later part of this week, early part of next week. I'm going to pass back to Anna and we will get going. And as David said, lots going on, particularly on the dollar. And I've got commodities workspace as well, so we'll talk about that as well. I know Anna wants to talk about oil too, so I'll pass back to her. If you have any questions, please just drop them in the chat box. Happy to answer them on there if they're short questions. Longer questions, we're happy to, I'll answer those on air for you, or Anna will.
I have actually calmed down. I'm not really going on a rant, but I would say this, and let's just pull up a chart. It's much more interesting to look at a chart. Here we are. There's the CL. There we are. No, that's the gold chart. Let me pull over the oil chart. There we are, because the oil chart actually makes the case for me. I have a lot of emails, hundreds of emails from people. Well, I have thousands of emails, but over the last 5 years since the books started to publish these books, and for the most part, I have to say, they are very complimentary, very grateful, opened a lot of traders' eyes, investors' eyes, how to read a chart, what they're looking at, basically trying to establish, you know, not just where the market is going next, but what you're actually seeing on the chart is authentic, it's genuine. And I suppose if you want to, you know, have the 30-second elevator pitch for VPA, it is this. It does two things. It validates what you are seeing on the chart, or it highlights an anomaly. And then I have emails from traders who say, well, I'm only price action. I think volume is a load of hooey. It's rubbish. You know, it's too subjective. You can't systemize it, etc., etc., etc. Which I fully accept. I have never said, and David has never said, and we have never written, and we would never do this, to say, if you want to use price action, if you want to use different indicators, if you want to do your approach, fine. There's absolutely nothing wrong with it. But just consider volume, because volume will help, as I said, to validate what you are seeing on the screen, to give you more confidence in the technical setup that you are seeing. And not only that, much more important is when a price is in a huge move, as we can see here with the oil price, where since it's moved away from the $68 a barrel, right down now where it's 50, and you're seeing this massive downtrend, and you think, and you know, you will read that traders will say, oh, you know, you can't chase price, you can't chase price. If you understand the price action with the volume, it will give you the confidence, or it will highlight those points in these big moves, not just to the downside, but also to the upside, when with a degree of confidence that you would not normally have. You could say, okay, then possibly this is a potential re-entry. I don't think actually anyone in their wildest dreams would have imagined that the oil price since the beginning of November would have fallen, well, actually from $70. I've taken $68 because we've actually got the volume, I've got the volume point of control in about the $68, $69 a barrel. But it's this huge resistance here at $70 a barrel. And I just want to highlight a couple of things to do with price action. Now, if we take this away for a second, and as I said, I'm not critical of people who just want to use price action, because as we always say, by all means, price action is fine. You know, you can interpret it how you wish. You can use volume, you can use bars, you can use candlesticks, you can use whatever charting method that is available. That is entirely at your own discretion. But if I could just draw your attention back here at the point where oil was kind of basing, it had obviously had this run up to just over 78. I think it almost got to over $80 a barrel. Then you had this two-bar, you can see here, you've got this two-bar reversal, you've got a bearish engulfing, which is a fantastic technical signal. And you could say, okay, well, that's clearly going to, you know, there's going to be some sort of weakness coming in. Can I, you know, is that a good signal to take? Yeah, for sure, because the two-bar reversal, bearish engulfing, bullish engulfing at the bottom of a trend is a great signal to read, particularly on the longer time frames. So you say, okay, I'll take that down, and then it comes down here back to the 60. Where is it? The 68 in this region here, basically. And as a price action trader, you would then look over to the left and you would say, oh, well, yeah, it's tested this area before. That's great. Well, we've had this pullback, you know, oil, OPEC, and they're constantly saying they're going to cut supplies. And, you know, generally the market is always, the suppliers always want, the producers want higher prices, and many of them need higher prices because their economies won't function with low oil prices. You know, they all have the break-even price that below which they are in serious trouble. And you know, you've got Venezuela, poor old Venezuela at one end, and even Saudi Arabia. I think their break-even price has risen quite considerably in the past sort of 5 to 10 years, as it were. But so you look there and you think, oh, that's a nice, you know, talking about support. Well, it's got strong support. Possibly there's a move higher, and you do actually get 3 little candles going up, and you think, okay, fine. What then happens is you actually get the start of the break break down, break away from the volume point of control. And what you have here is very, very interesting, because you have this, with the volume, you have this down bar, you have a heck of a lot of volume underneath it. You then have a very squished up candle with a ton of volume underneath. And you have two more up candles with reduced volume. Then you have a down candle with not so much volume. And then you have these very compressed candles with a ton of volume underneath it. What is that telling you? Now, if you accept that price and volume, for price to be valid, to price to be genuine, you has to be accompanied by commensurate volume. That is a huge anomaly. You wouldn't know that simply by looking at the price action. So as for price action traders out there, fine. If you are confident and comfortable in how you analyze your chart, I applaud you. I would never foist my opinions about chart analysis onto you. All I would say to you is I would ask you to consider how much more confidence you would take, or at least we would pause and think, reflect, maybe this isn't going to go higher. Maybe actually there's an awful lot of selling coming in. There is pressure there, but it's not going any higher. And as I said, the emails come to me. Some of them are actually quite rude and quite abusive. But hey, finally, all I would say about this, as we say in some of the copy on one of the books on Amazon, if it was good enough for Jesse Livermore, if it was good enough for Richard Ney, and if it was good enough for Charles Dow, it's good enough for me. So that's all I've got to say. David, do you want to say anything about the chart?
Yeah, absolutely.
Oh, sorry. Do you want to talk about the I mentioned about the re-entry. So do you want to mention that? Yeah?
Yeah.
Fed up with listening to my voice.
Never fed up listening to your voice. Can you hear me okay? Yeah? Yeah. If you want to, the emails we've received over the years based on topics like that are very minor compared to the vitriol that we received following our analysis of Bitcoin back in January, when we did suggest it was trading at 10,000 and was likely to go down to 3,000 and probably sub that, much deeper still. So there we go. That was, 9 or 10 months ago. But I can assure you we had some vitriol full of expletives. How dare we say such things, etc., etc. But there we go. It's a free market, free world. I just wanted to follow up on a couple of things with this chart, and then we'll move on to other things as well. But this really does demonstrate in lots of different ways the confidence that having volume and price together will give you, as Anna said, in the analysis of the price action. And whilst you can interpret a certain amount from price action alone, it really does reinforce whether price and volume are in agreement or whether they are in disagreement, because really and truly, that's what you're looking for the whole time. And indeed, in the last 2-3 weeks, the widespread down candles, which in themselves are self-evident of bearish sentiment, when you see the volume associated with it, then you know for a fact that price action, that move in the market is genuine. The wicks to the candles are very short. In fact, there's virtually none of them certainly on the last candle down at any rate. And the volume is in line. Those three are pretty much identical, not quite, but pretty much there or thereabouts. The volume is pretty much the same. It's just telling you loud and clear that bullish sentiment remains intact, that the volume and price for those particular days was in agreement. There was no anomaly. It wasn't a fake move. It wasn't a trap move. It was genuine. And that bearish sentiment remains in control for the time being. And that's the power. And if you scroll back somewhere towards the middle, I think it was middle of September maybe, where you've got a little bit further over, darling, as you go through the resistance. No, other way, sorry, to the right. Sorry, beg pardon. There we are. Keep going, keep going. Stop, stop, stop. It's a bit like Golden Shot for those of you who remember. Sorry, showing my age for those of you in the UK, apologies. But as you start to move away there, the market appears to be breaking higher. And you've got a lot of volume coming in under the candle, 3 bars back, 2 bars back, 1 bar back, keep going. That one. No, Okay, move over to the right two, sorry, that one. There we go. You've got high volume under that candle, and yet the price action is very compressed. What is that telling you? Well, it's telling you that you are seeing buying coming into the market, but the market is very resistant to higher prices. Now, as we've said many, many times before, when you see a signal like that, it doesn't indicate directly that the market is going to roll straight away. What it's telling you is that there is weakness in this market. The sellers are selling into this market. The market is resistant to higher prices. The big operators have moved in. They're selling into weakness. It does not necessarily mean that the market is just going to roll over for you and the following day you're going to get a nice development of a bearish trend. What it is telling you loud and clear is that there is weakness in the market at that point. And as always with VPA, we have to wait, we have to be patient and not take a signal as it arrives on that particular day or on that 5-minute chart or wherever the time horizon might be. But that is telling you for sure there is weakness. The market is resistance at that point. Yes, we see it rally by another $3, $4, $5 a barrel, whatever it is. Then we get the 2-bar reversal at the top. Then we start to roll. But the initial signal came in maybe a couple of weeks before that, or a week or so before that. And that is always the case. That is often the case. You see the initial signal. The market may carry on in the same direction for a little while, to either the upside or the downside, but it is a sign of weakness. And then it's a question of what happens thereafter and how that volume then plays out in the context of what you've seen before. So it's really mapping everything back all the time. So when you see a signal, you pocket it, you say, okay, fine, I've seen the signal. You then see how the price action develops. You're then reading the associated and following price action and volume with what you've already seen as a potential signal, and then you start to put it all together. Given what's going on with oil right now, oil is one of those, and I said this at the time, this is 3 or 4 years ago when oil was having another big collapse. Oil is one of those commodities that a lot of traders, and certainly investors, but certainly traders, find hard to trade to the short side because their mentality is very much like a stock. This market should always go up. Why? Because oil is a resource that's in short supply, and ultimately there will be none left. So therefore, the price should always go up. That's the mentality. So when you're trading this market to the short in these long bearish trends, you have to put that element to one side. Forget about it. You just have to trade what you see on the chart, and that's another of the powers of volume price analysis. It helps you to do that, to forget about the bullish or bearish bias you may have or what your brain thinks should be happening. It's what is actually happening on the chart. Just going to switch off for a moment, pass back to Anna.
Just a couple more things on this before we move on. The one thing as well is once you learn to interpret the charts in this way with the price action and volume, as I said, there are tons and tons of examples in the books that are up on Amazon. There's 200 worked examples in the stock book, and there's also worked examples for the forex market, and the commodities is in the stock book, but there's all sorts of things. It's one of the very few ways that a historic chart, the patterns that you see with regard to price action and volume, they are so repeatable. Often when we look at historic charts, and you will hear this, and we've said this ourselves, that a historic chart is useful up to a point, but it's extremely useful when you are picking out these kinds of anomalies that you see. As I said, you'll see them in all time frames because they repeat, so that when you come across them at the live edge of the market, you'll think, ha, that's it. So that's fantastic. As I said, we go into this in great detail. Certainly on the Forex program, where we talk about primary trends and secondary trend and minor trends, this is a very Wyckofian view of the market and of a chart. It doesn't really matter with this; just happens to be oil. So this is our primary trend, but it's knowing when you have this potential reversal, how you judge that potential reversal, what criteria you use, whether you just use price action, whether you use support and resistance, whether you use supply and demand, it doesn't matter. It's knowing whether that is going to be a genuine start of a reversal, or in fact, it is simply a secondary trend in the primary trend there. That doesn't mean as a trader you can't necessarily trade that that pullback correction, call you what you like, but at least it will help to it'll help you identify when a similar situation comes up in the future. And as I said, with the re-entries, again, it's the kind of candles we talked about before, where you have this effort to rise once again with a ton of volume underneath it. Those are potential re-entry signals, and you won't just see this on oil, you'll see this, as I said, across the market. What's happening now is obviously this basing at $50 a barrel. Everything about oil is actually on my Facebook page. It's called Commodities Trading. There's about 4 or 5 posts on the kind of levels that we're looking at. And I actually said with the 50, it often does actually bounce off the 50 as well. So, you know, it's a great chart, but it's a great chart to look at, even if you don't trade oil, because of the lessons that the price action and volume can give you. But as I said, if you want hundreds of examples, the books are out there on Amazon. So before, as I said, we move over to David, very quickly, what to look forward to, certainly in the next sort of week or so, and we're coming up to December and then Christmas. As you'll know, for trading, the markets are very nervous, they're very volatile, which is great because it means things are moving. Not so clever for investors at the moment, because it's you know, things are making them very, very nervous. Traditionally, we have what's called the Santa Claus rally. There's certainly there's no clear evidence of it yet. I think Santa's still in his grotto at the moment, not deciding whether to come out. Lots of reasons for it, amongst, and I said this a few weeks ago, really have to listen to what the Fed is going to be doing, certainly with their December meetings. There's a lot of Fed speak going on at the moment, but there's only 3 people who really carry any clout with the markets. One of them is Powell, clearly the chairman, the guy called Clarida, I think it's the man, and Williams, I think he's the president of the New York Fed, but correct me if I'm wrong. Everything else is just noise. And it's quite interesting. You talk about the noise, the signal and the noise. The signal is Powell, Clarida, and Williams. Everyone else on the Fed board is noise. They don't carry any weight in terms of voting. So that's really why, and you need to pay attention to that, because if they create volatility, it's going to be great for you as an investor. Very, very different situation. And of course, we're coming up to the G20, and of course Donald and the Chinese and the tariff rows and wars and tensions, call them what you like. And those are the excuses, those are the reasons that are given out there by the media when, you know, stocks and indices take a swan dive. So that's all I was going to say on that one. Do you want to move straight over to you? Is that okay, David? We've been looking at a load of stocks again. As I said, if you've not come before, let me just bring up the where's my let's have a look here. Finviz, basically. Huh? I've got it up. Yeah. I basically picked off some stocks. This is the criteria that we've been looking at. This is purely, as I said, from a day trading perspective. What are they telling us? This is the list that was delivered by. This is the free version of Finviz, but we're going to be looking at a paid version. And you can see the criteria. We've got a market cap of mid 2 to 10 billion. The average volume of over 500k. Float. We don't want a huge floating supply, because stocks that have a huge floating supply, they take a lot of effort to actually manipulate and move. So I've gone for under 15%. There's no, I'm sort of playing around with these values. And a relative volume over 0.75. That means it's moved over 0.75 more than it normally moves. It's relative, and volume is relative anyway. But I've added this filter in as well. I've actually got the optionable and short, and the price is over $10. And the ones we've selected, they all give another volume price, VPA perspective, another lesson. But as I said, VPA is fantastic, historic, real time. Once you get to grips with it, it really will. And what does it do? It really takes away as much of the uncertainty as possible. And this is an uncertain environment we operate in. We have to accept that. And it's really your comfort level. How comfortable are you? operating in such an environment. David and I, we've been at it so long, it really doesn't, uncertainty doesn't phase us, it doesn't bother us. And what I'm trying to say, so it's an uncertain environment anyway. And what was I trying to say? I can't remember what I was going to say. Let's pass over to David, because the examples on the chart, as I said, they just deliver lots of lessons, and from both from a historic perspective and from a real-time market perspective. Is that okay, love?
Just changing screens, bear with us a moment. And there we go, show my screen. Still not hearing, there we go, I've got myself in my headset now, it's better. There we go, it should be coming up. Is that come up on your screen? Okay. Yeah, brilliant, okay. Sorry, yep. Sorry? Yep. Anna's just remembered what she was trying to say. Hold. No problem. It's all right, she's remembered what she was trying to say. We'll come back to that later, hopefully. Right, what I've set up here, same as last week, and I've tried to bring in the element of using a multi-time frame approach, because what we have here are 6 workspaces, or 6 charts rather. On the top we've got the 5-minute, the 10-minute and the 15-minute, and down at the bottom we've got the 30-minute, the 60-minute, and over onto the daily. And this is all for the ES, which is the E-mini for the S&P 500. We've been trading, what, little bit now, over an hour, certainly, over an hour and a quarter or so. And it really does bring home to you not only the importance of using multiple timeframes, but the opportunities that traders, intraday traders, particularly on this occasion, will be looking at from all the various perspectives. What I'm trying to say is, if I blow up the 5-minute chart here, this is on Globex. The volume on Globex is always compressed when the physical and the electronic are running together, because this represents the surge in volume that always happens at the open of the physical markets, the bricks and mortars exchanges, if you will. And prior to that, this is on Globex. Now, one thing that's instantly apparent is that, and I've said this before, is when you're trading on the electronic market only, the price action tends to be more measured and even paced, even for an index such as this, which is the most volatile of all the futures contracts, bar none. It is the one most heavily traded. It is the most volatile. And a lot of people maintain that you shouldn't trade just on Globex when you're not trading with the physical exchange running in parallel. I beg to differ. I would suggest you actually the reverse of that, and I would say that applying VPA just on the electronic side is actually more straightforward, because once you enter the realms of the physical market running in parallel, you're also dealing with all the high frequency trading issues which cause this immense volatility, which is often the characteristic at the start of the market. This is where we started. This is 2:30 UK time. This is the 5-minute chart, and this racking about in volatility is just so typical of what you see in the first 10, 15, 20, 30 minutes or so. Very typical. The point I wanted to make here was that even though we are trading in a relatively narrow range, there will be a lot of traders who could have taken opportunities to the long side and the short side. For example, when you see this, the depth of buying, the strength of buying coming in on this single candle, that in itself is sufficient, given the associated volume, and we're comparing the volume across these 3 candles here. Given the associated volume, that will be sufficient to certainly signal that potentially there's an opportunity to the upside. Now, given that a lot of index traders will only be looking to take 2, 3, 4 points out of this market, that's a significant opportunity. And sure enough, it delivered. We had a further replication of it here. And as the price action got underway, certainly on these 2 candles, we had rising price, rising volume. Now, there'd be nothing at that point to suggest that we are about to see a reversal. And the point about that is that if you're an intraday trader trading on a 5-minute time frame, then on a 1 minute and a 2 minute, which would be your upstream or downstream, however you care to look at it, that is what you'd be looking at in terms of other signals arriving on those faster time frames to tell you what might be coming at you in terms of your trading time frame. So when you look at these charts, it's on the basis of what is my approach to the market? What is my time frame? Am I looking at this as an intraday scalping opportunity, really fast time frames? I'm just looking to take 2, 3, 4 points out. My preferred, certainly when I'm trading something like the YM, for example, I'm looking for anywhere between sort of 20, 30, 40, 50 points, something like that. That's my comfort level, if you like. That's what I'm looking for. But I'm sure a lot of traders take far less than that. So when you look at these charts and start to move across, it's really trying to understand and put yourself in the frame of mind of someone who is trading this, looking at what their time frame is and interpreting accordingly. Now, from a 5-minute perspective, you move up to the 10-minute. If you were trading this on a 10-minute time frame, would you have taken any trades on that time frame? Maybe, maybe not, because you've got so much volatility in these first 3 candles here, volatility on volatility. You then get a decent signal under this one. Would you be prepared to take that? Well, there's 5 or 6 points in there, quite possibly, possibly not. That's a personal decision. You go up onto the 15-minute. Now you're looking at a long-legged doji to start with, extreme volatility. We're trading inside the volatility of that candle, and then we get another volatility candle to follow it up. So, if you're trading a slower time frame, what is that telling you? Well, it's telling you that to expect a reversal or a pause point. It's reinforced by the fact that we've got some reasonable resistance at this 2674 area, as denoted with the blue dash line, which is the accumulation distribution indicator on NinjaTrader. And we've seen the price retrace within the spread of the candle, which is no great surprise. And just to, I suppose, reinforce the aspect of volume comparison across the 2 time frames, or across the 2 opportunities of either Globex or Globex plus cash, or plus futures rather, this volume here, I can assure you, was extreme, as indeed was the price action. We had this big spike in price action, lots of volatility, lots of volume under it. What are you expecting? Are you expecting the market to strengthen from there? Not really, no. And it was reinforced. The price action tested this level again, reversed lower. As I say, all this volume is now squashed because of what's been going on here. But I can assure you at the time it was very demonstrative. You then move down to the 30, and we see what's going on the 30. And that really just encapsulates the fact that from a slightly slower time frame perspective, then we are just trading in volatility. We've got the volume point of control sitting here. We've got lots of volume around the place. We've got a huge histogram that goes way out to the right of the chart, goes off the side of the chart. And in addition to that, if we look across the time frames, we've got the volatility, we've got the VPOC here, we've got the volume point of control here, we've got it here, we've got it here, and we've got it here. So all of that is just simply reinforcing the fact that we are trading in a congestion phase. There is, as Anna said, there is a massive amount of uncertainty around at the moment. There is so much going on in terms of trade wars and what is likely to happen or not happen, both in the US with regard to China. We've got the same sort of issues with regard to the UK and the US and the UK and Europe. It's all this melting pot of trade wars, who's going to do what, and so on and so forth. It's hardly conducive to strongly bullish sentiment in stocks. Having said that, you have to trade what you see on the screen. And in addition to that, perhaps more importantly still, is that whatever you decide to do, certainly from an intraday perspective, as we saw here, there are opportunities, but you've got to be light on your feet. I would suggest at the moment, certainly today has not been, this is the daily chart, it's not one that's going to, it may explode into life, it may not. We've seen very typical days where you get a strong move in one direction in almost like 2 halves of a football match or a game, where you see strong selling in one half followed by strong buying in the other. But that's often the case, and you'll see that reflected in volume. What we're seeing on the daily, which just gives you context, is we're testing this region here. pushing higher. We can't really get through there. And in addition to that, we are, if you like, in a bearish phase of price action. We've gone through the volume point of control. We've broken away from that. We broke away on decent volume here. Again, these two are in agreement. We've got a decent volume here. We've got a nice widespread down candle. This was a narrower spread, but nevertheless decent volume. The only caveat is obviously around this region we've been dealing with Thanksgiving. So by virtue of that fact, there will be light volume activity through the holiday seasons, and we'll see it through into Christmas. But that aside, it's not looking terribly strong at the moment. And in addition to that, where you see strength in the dollar, which we've certainly seen on an intraday basis, I'm not sure what it's doing at the moment. Let's go and have a quick look over on commodities. Let's just have another look. It was going up. As David said, it was moving up pretty strongly. There we are. This is the dollar down. Just move the chat box out of the way if I can grab it. There we go. That's the dollar. We had this very strong move from the open. You know, that's not helped. Bit of a retracement. That's probably helping a little bit. Now we're starting to see it pick up again. And that, of course, this is the commodities workspace. These are different time frames with different commodities. I've got oil up here on the 5 minute. I've got the middle here. I've got gold on 15. I've got silver on 15. I've got corn down here on 15. I've got soybean on 5, and I've got the Aussie, not the Aussie dollar. I've got the US dollar here over on 5. Let's just pull that over a little bit, get some more can. Sorry, darling. Yeah, absolutely. Just going to pass back to Anna for a minute, and then we'll come back onto this because this is also very interesting.
Really, I'm not going to change screens, but there's just a couple of things just to be aware of. We talked about volatility, and of course, the place to check out volatility is, of course, the VIX, and the VIX is trading in around the 20 area at the moment. So that immediately tells you things are going to be volatile. As I said, as a trader, that's great because you're going to find things that are going to be moving. And another reason for the volatility and all this carry on in the markets, I know we've got tariff wars and et cetera, is you'll be hearing more and more is whether the Fed is going to come out with what they call the Fed put. And that's basically, very, very briefly, rising interest rates are not conducive to positive returns, good returns on the stock market, because as interest rates rise, the cost of borrowing rises, the cost of servicing debt rises, companies can get into all sorts of trouble. There's been a huge amount of over leveraging, taking on more debt than maybe they should have done. So it's really not very clever for, as I said, for the stock market. Now, when this has happened in the past, particularly with Greenspan, you'll read about it. You can look it up in Google, the Greenspan put. And that's basically, it's the stock market volatility and general tantrum, if you like, that will actually possibly have influence on what the Fed may or may not do with rising interest rates. QE is kind of history now, but it's something, again, you may want to add to your sort of general knowledge of this background stuff. You know, these charts don't move in isolation. They're driven by all sorts of forces, and of course you have a huge amount of manipulation as well. It's just one more thing to be aware of, as I said, particularly at this time of the year. And of course the Fed will be paying attention to, they say, to the fundamental data. What they pay attention to is not necessarily what the market pays attention to. But anyway, that's just something I wanted to say. Pass back to David. He's got, are you going to you've got something to say? Yeah?
Well, I've always got something to say.
Fine. If you've got any questions, just put them in the chat box. What we should have said earlier is the charts you see at the moment are from NinjaTrader. They have some of our indicators that we have developed for NinjaTrader. They are the indicators from what we call the Essentials package. It's basically the indicators that are non-forex specific, so David can explain them in a little bit more detail, and they really were developed to underpin our volume price analysis methodology.
Thanks, darling. Just blimey, yep, okay, time flies. Just to reiterate what we've got here, we've got oil top left, gold in the middle, silver on the right hand side, and down the bottom we've got a couple of softs. We've got corn and soybean. And what I wanted to highlight here was really just the relationship with the US dollar, which, if you remember, is down here bottom right. This is on a 5-minute time frame, so it's pretty fast. It's just giving you a heads up on what the dollar is doing on the various time frames. Let me just pop that up. There we go. Makes it a little bit easier to see. So that's what the dollar's doing. The question is that reflected across the commodities complex? And in some it is, and others it isn't. The relationship with gold and silver, and by the way, if you're trading gold, I would suggest that you have silver up as well alongside, for two reasons. First of all, because generally it mirrors what is going on in gold to a lesser extent because it has a smaller price range. But secondly, and more importantly, it will give you a different perspective on volume price analysis through the prism of an associated market. That is not to say it's going to be identical, but it will at least give you a different view on what it is you're trading on gold. So I would just put that on the table as an offering, if you will. The point I wanted to make is this: the relationship with the dollar for commodities, whilst it is generally linear, is not always the case. Correlations and relationships do break down. They're not hard and fast. You cannot say with any degree of certainty that that relationship will hold good forever. It won't. Generally, that is true. You can see it going on at the moment. You're seeing the dollar rise, and that is being reflected in both gold and silver. Now, what it's not being reflected in the bottom left are on the soft commodities of corn and soybean, and it's certainly not being reflected for the time being, at any rate, in terms of oil, because normally with a strong dollar, with the dollar rising, you'd expect to see commodities falling and vice versa. So the point is this: depending on which commodity you're looking at, it will have a more direct relationship or may be influenced by other factors. In terms of gold, particularly gold, gold is a precious metal, and its primary drivers are either risk or inflation. It's not really impacted greatly by other factors. Those are the two key drivers for it. So if the market is in panic mode, you'll see strong buying of gold. If the market's a little bit more relaxed, you'll generally see selling of gold. But if inflation is on the horizon and it's strong, you've got a hot economy, inflation is rising quite fast, which we're not seeing at the moment in any market, to be honest, that is when you'll see a flight to gold driven through inflation. So generally speaking, the relationship with the dollar is one that normally holds pretty good. Not always. It has broken down in the past. We've highlighted it. I think we've highlighted it in the program, actually, one of the reasons it broke down, and we've certainly done posts about it in the past. But what you're seeing right now is a typical relationship with gold and silver. It's starting to take effect with oil, but you can see there we've had a rising dollar and we've got rising oil price at the moment on a comparative 5-minute time frame. And if you look at the soft commodities of corn and soybean, they really ram home the point that you really have to understand the market you're trading, and you can't take the relationship with the US dollar as a simple linear relationship of inverse correlation. It's not that straightforward. And if you're trading those soft commodities, then there will be far greater drivers and impacts to that market when you're dealing with things like yield, you're dealing with back to trade wars, you're dealing with weather, you're dealing with all manner of factors which are going to affect that particular price, of which the US dollar will be one. So its impact in those sorts of commodities will be far less. In terms of gold and silver and generally oil, it will be more. But oil is another one where the impact of an OPEC statement or an OPEC agreement to restrict supply will have a huge impact on the price, far, far greater than any direct relationship would have with the dollar. So I just wanted to make the point because it's a really, really nice example right now. And again, what you're looking at, we just popped the gold price up for a moment. You know, VPA applies to everything. It applies to every single market. It doesn't really matter what it says at the top of the chart. This could be an ETF, it's a future, it could be a cash market, it doesn't matter. You just look at the volume. Is it in agreement? Is it in disagreement? What's it telling me? Am I seeing any signals coming in? And so on and so forth. And then all of that is backed up with the indicators. Volume point of control up here is sitting at well above, so that's adding real weight to the pressure of bearish sentiment right now on this 15-minute time horizon. You've got an absolute ton of resistance overhead here in terms of price action resistance. The volume profile is very thin in this region where we're now breaking down. You can see here where we've got low volume nodes on the volume point of control. The price action has gone through there like a knife through hot butter. Really very, very quick. And there's very little in the way down here of volume to prevent any further rise. Trend monitors bright red, trend lines diving nicely. Not a flicker to suggest at the moment that we're seeing any buying right now or reversal on that particular time horizon. And the same sort of picture on silver. As I say, if you're trading gold, have silver up. We had the effort to rally. Look at this candle here. We've got a ton of volume coming in. Tried to rally, nice wick to the upper body. Really, really weak price action, and the market rolls. And we've got a similar price action here. The market's tried to rally, hit some minor resistance here. Decent volume under that one. Trend monitor's still red. You know, down we go. We're going down to $14 per ounce probably, and on we go. You know, down the hill. Trend lines diving nicely as well on that one. Volume point of controls adding a lot of downward pressure. And again, we've got this absolute ton of price resistance sitting overhead from this earlier congestion phase over here, which was going on this morning and through the London session. I'm just going to switch off for a moment. No, I won't actually, don't worry. Let me just head over to, let's go back to the index workspace, see what's going on there. Just move that out of the way. Trying to rally, and you know, again, it's back to this issue of, are you comfortable taking a trade on these fast time frames, or are you going to wait as a slower term time trader, trader to take an opportunity? For example, if you're looking at the 30-minute, are you going to wait for this to break through this level and close above here? Are you looking for a move beyond the high of this peak here at 26.85? Is that your comfort zone? You know, what is your comfort level? The trend monitor is starting to transition here into blue, so it's suggesting we're starting to see a turn in sentiment, a reversal. Up on the 5-minute, that has been going on for some time. If you're a 5-minute trader, you know, maybe you sat through all this, maybe you did, maybe you didn't, maybe you're comfortable in sitting through that, maybe you're not. If you did, then you're taking advantage of it. If you got out, then you know, it's a question of at what point do I jump back into this market? Because for the time being, it certainly appears to be trying to rally and move higher. We go up to the 10-minute. What's the 10-minute telling us? Weakness on this particular candle. You know, it doesn't look terribly strong, but you know, we'll see how this one closes off. Again, do you want to get in after it's gone through here, when it's gone through this region? What is your comfort level? Trend line is rising now. Trend monitor is remaining blue for the time being. Hold on a minute. And just to drop down onto the daily, just move that out of the way. This is where we are on the daily. And from a daily perspective, we're now moving up to test this minor resistance area here, which I mentioned before. That, of course, had no change on the trend monitor. You wouldn't expect it because it's way out on a much lower time frame. If we head on over to the non-time base workspace and just see how that's reflected. And again, I mentioned this last week, but if you're using time-based charts, I would urge you to use non-time-based charts. The Renko is just brilliant. It smooths out the price action and will help to get you into positions. But more than that, it will help to keep you in as well, because what it does is it smooths out those areas of volatility. It also highlights, if you're an intraday trader, those opportunities of grabbing points. They are much more clear cut, they are cleaner, and it is just a more structured chart purely through because you are dealing with a brick. Now I've got this running on 4, and what the Renko optimizer does, it delivers the optimal brick size for the market we're trading. We're trading the ES right now, and I'm going to just select the 1 minute here. And we've actually speeded up now because we were trading 4. In other words, the smallest increment, which is a tick. So we were trading 4 ticks, which is 1 point. I'm just going to click this. This is going to open our 7 brick Renko chart. In other words, we are now trading 7 ticks. So we're now trading 1.75 points. And the reason it's changed to 7 is because the market is now speeding up. When I had it running on Renko, it was prior to the market opening. We're now running in the market open. and the optimal setting for trading the ES at this precise point is 7 ticks, 1 3/4 points, and that is delivered automatically. So it's just a really cool way, and it's a less stressful way of looking at price action. And if you use it in combination with time-based charts, it really will help you. If you don't use it to get in, don't worry. You can certainly use it to help you stay in, because it will smooth out the spiky price action. That's the tick speed. Oh, sorry, let's go to the tick chart first. Just pull that up. I've got that running on 205 ticks. Let's just see what the speed is at the moment. Certainly faster than that. But when you're running with either a tick chart or a time or a Renko chart, what you're doing is you are removing the element of time from the chart. So you are seeing momentum. On the tick charts, you will get the same sort of candle formation, but what you will see is raw momentum, the speed of movement. And that is certainly true, exactly the same on the Renko. As the market speeds up, you'll see the Renko brick creation speed up and slow down. You don't see that on a time-based chart. So it's just a really, really powerful way of using non-time-based charts in conjunction with a time-based chart to help you in your trading. Yeah, sure. Sorry, I always have the chat box closed. I do apologize. It's not I don't want to answer any questions. It's just
Just go back to Louis and the 2% rule, and Mark has got
yeah, okay. If I can get the question box open.
it's a bit of a pain, isn't it?
Sorry, go to webinars being a right pain. Here we go. Right, where are we? Mark, on a 30-minute, I noticed falling volume through a strongly rising market. Is that something to be worried about? Absolutely, Mark. They are the classic signs of weakness, and the same is true in a falling market. If you have a falling market with falling volume, that is suggesting weakness in the downwards trend, because for a market to fall, you need rising volume. It needs effort in exactly the same way as it does to rise. So if you're seeing a market that is rising and you're seeing the volume fall away, what that is telling you is that this market is weak and is unlikely to move far. And therefore, you're expecting it at some point to roll over. Now, that may be a full-blown reversal from a primary trend to a primary trend, or the other powerful application is where you are in a primary trend and you see the market rally against you. And that is probably the most powerful application of VPA of all, because what you're seeing, what it is helping you to do is either to get in, but more generally is to stay in. You've seen a nice move lower, for example, and the market then reverses against you. As the market reverses against you, you're looking at the price action. If you see the volume falling on the rally, that is telling you that is weak and is not going to go far. What you'll also see in that scenario is you'll see heavy selling coming in and weak price action. In other words, you'll see a wick to the top of the candle. The market's tried to rally, it's fallen back, there's lots of volume coming in. That is basically the insiders, market makers, the big operators selling into weakness prior to the next leg down. So if you see that in combination, and you often do, you'll see the market going lower, it will try to rally, volume will be falling away, then you'll see some selling coming into the market because you'll see weak price action with a wick to the upper body. Doesn't matter on the color of the body, whether it's red or blue, but with decent volume under it, that is the insiders selling into weakness prior to establishing a move lower to the next leg down in that particular move. And that is classic. That's a classical entry to look for. If you're not in that move, then it's certainly one to look out for, because if you're not in the trend early, perhaps it was a congestion phase that broke away and you didn't get into. You don't do congestion phases. You're not a breakaway trader. You're more of a trend trader. And if you're looking to jump on a trend and you feel it's moved, but now it's gone into congestion, that is a typical re-entry signal that would get you into the next leg down. So absolutely, I hope that answered that one for you, Mark. Right, just going down the other questions. But I'd say your follow-up question is yeah, that's on the ES. It would apply to any, this was the ES, but that universal aspect to VPA applies to anything. Could be ES on a minute, could be oil on 5, it could be gold on the daily, it could be anything. It doesn't matter. It is one of the, it's just the way, it's the power of VPA. It's just a great methodology because it doesn't dictate to you what your tactical approach is. It just helps you in whatever it is you're trying to do. Jeff, on your CSI reversal, do you sometimes take the trade in the way of the trend and then take it on the reversal? I'm just rereading that. Do you sometimes take the trade in the way of the trend and then take it on the reversal? I think what I'm reading is do you join the trend higher and then reverse out on the reversal? I think that's what you're saying. Again, that's it's a personal decision. If it works for you, fantastic. There's no right or wrong way to trade. The decision you've got to make, and if I think I read it correctly, is if, for example, a currency is, let's say it's 3/4 of the way up on the CSI and it's approaching maybe an overbought situation, the decision you've got to take, and only you can decide, is looking at your price chart, how much further you think that's got to travel. And if you think there's a decent opportunity there, fantastic. Take it. You jump in. You maybe take some pips out of it and get out. Then you start to see maybe it approaching that reversal point, and you're then looking at it from a different perspective, because in the first scenario you're looking at it jumping on an existing trend. In the second scenario, you're very much looking at it from a reversal perspective and getting into a reversal early. The two are very different, because on the first you'd be looking at a very tight stop regime, and on the second you'd be looking at a very wide one, because you've got to allow time for that reversal to develop. Whereas in the first scenario, you haven't got to worry about that. You just want to jump in, get in as quick as possible, go in with a tight stop, grab whatever's available, stay in for as long as you can. When it gets the reversal, get out. And then obviously, as you're saying, trade to the opposite side, which is absolutely fine. So absolutely no problem. Delighted that's working for you. Sorry, where are we? I've missed that one. Someone asked about a 2% rule. Sorry, let me scroll back up. Gotcha. Can you explain the 2% rule? Absolutely. It's one of the many metrics that, excuse me, I'm just going to clear my throat for a moment. You don't want to hear it on air. Yeah. Okay, right. I'll just scroll back up to Luis, and then I'll scroll back down again to David's point. If I've misinterpreted the question, apologies. The 2% rule, Luis, is one that is one of many filters that you apply when you're looking at stock selection. It doesn't have to be 2%, but basically the 2% applies to a price move. So what you're looking for as a filter is to say, okay, well, of these 10,000 stocks that I've got to search on, one of my criteria is that the stock price has moved by 2%, let's say on the day. And that will automatically filter that list from 10,000 down to, I don't know, 1,000, 1,500, whatever it may be, depends how volatile the market's been or the strength of the trend, whatever. And that will just be one filter of many. So it's basically 2% of the price move on the day. So it will filter out those stocks which are actually moving. You will then overlay that with a myriad of other filters, or perhaps keep it very simple. We used to apply things like volume, obviously, was one of them. We'd reduce down to mid-range stocks, not necessarily blue chip stocks. So you go on a market capitalization size, and you'd apply all these factors. You'd look at all sorts of, and you'd look at sectors, for example. So you'd say, well, okay, let's go and have a look at the sector. What is that sector doing? Does it look strong or weak? Let's filter out on the sector, because I only want to deal with these stocks. When you're and it also goes to the point of dealing with specific approaches or particular approaches. For example, we were very heavily involved with covered call writing and options, and you're looking for specific patterns of price action. So in that scenario, you're looking for something very different. You're looking for stocks in congestion, which are mildly bullish, as opposed to what you might be looking for as an investor, where you're looking for stocks which are perhaps rebasing, finding some momentum, etc., etc. So there's all sorts of factors. So I hope that answers that one for you. Let me just scroll down because I think, right, Jeff, what I do is look at the, right, David, thanks Dave for jumping in there. David says, what I do, Jeff, is look at the angel, but I know you mean the angle of reversal when it's coming back from, say, 20 line and the angle is shallow, then I see this as a chance to sell is once the reversal sours. It is very much about, I know we're moving away from stocks and indices and everything else, commodities, but when you're dealing with the currency strength indicator, it is very much about that, because what it reveals is strength and weakness in terms of the angle of inclination. So when you're seeing a strong angle, it means the market is moving very strongly for that particular currency. And of course, the dollar is one. And even when you're trading, I know we've broken out the Forex indicators from the Quantum Essentials package for NinjaTrader. But when you're trading risk, which you are as a stock trader or an investor, or indeed any of the commodities, then seeing what the dollar is doing, and equally importantly, seeing what the yen is doing, isolated out, to us is just as important, because it reveals so much about sentiment. So yeah, absolutely agree with you. It is very much about the angle of inclination. The same applies to currency array, where you're seeing steepness of lines which immediately give you a heads up as to the strength of a trend or the strength of buying or selling for that particular currency or that currency pair. I think I've actually managed to get through the questions. Bear with me a moment, just scroll right the way down. Yeah, I know, we haven't even got to the stocks yet. Hold on a minute. Yep. Yeah. I mean, this is the Renko, just to tie this back to what's going on the time-based chart. So you can see we're topping out. You can see the trend dots here are flattening off. We've gone to grey, got a couple of pivots formed up here. So this is a pause point. This is, we're reaching a point where the market looks weak. It's not terribly strong. So, you're over to the time-based charts. And it's not easy to do this on a webinar, but we'll do our best. There we go, back over onto time-based charts. So what are we seeing on the time-based charts? And yeah, I will do. Well, probably the 15 is the most demonstrable, because we traded within the volatility candle. The market's tried to rally, real deep weak to this one, and we've had a repeat performance here with decent volume under here. Remember, we're comparing volume across the time horizon here and not going out over into this lot here. So this in itself, as I said earlier, price action will tell you a certain amount. Of course it does. It tells you, certainly from the wick perspective at any rate, what is weak, what is strong, and the expectation here, we've got the volume point of control sat here as well, all adding to it. We've got some decent volume around this region. It's trying to break through this. It did actually get through, but it didn't really close above it. Decent volume underneath, so that's not looking terribly strong. Let's go down on some of the other time frames. It's a market that is I would classify it as fragile. It hasn't got that. When you're trading, you get a sense of the fragility of the nature of the market. You get a sense of when a market is really moving strongly and you feel very confident about taking a trade. Can't describe it, but I can only describe it in that way. So you will be much more confident of trading at that point. The market at the moment is very fragile. It's nervous. It doesn't like all this uncertainty, and that's really reflected on what you're seeing on the charts right now. It's nervous. It's not going to advance very quickly at the moment, and it's not reflected in the volume or the price action, which is this constant. Well, we can go a little bit higher, but really, there's not a lot of buying here, and the buyers are just not coming in. It's the opposite, if you like, of Bitcoin, where everyone is selling right now. It's got momentum. Where it's going to end up, who knows, but that's a different subject. So that's what you're seeing. You're seeing that on the price action, and you're seeing that reflected on the Renko. And using the two alongside one another is a very, very clear, simple way of using it. You can see how on the 30-minute, you might not be able to see it very clearly here, but that's the wick that's developing on the 30-minute. So again, you know, we're trading in such a tight range here. We're 55 to 75. I mean, it's 20 odd points, which, okay, you know, is a half decent range. And I said at the start, intraday traders, yeah, you could take some points out of that if you feel comfortable doing that. But certainly anything longer than a sort of 10, 15-minute time horizon, you know, it's not going anywhere at the moment with any degree of certainty. So it's time to sit by and sit on your hands and wait for something better to come along. It's patience. Unfortunately, none of us are very good at patience. We're not. And we just have to be when the markets are in a sort of febrile state, which they are at the moment. Just going back to the stocks. Let's pull this one up. There we go. Yeah, you can. I'm just going to pass back to Anna.
While David decides on what he's going to, just to sort of wrap up the, as I said, we looked at these 6 stocks from the FinViz. We selected it from the criteria that I showed earlier on, and they all tell us something slightly different about VPA. And a very question from Shugai. Thank you. That's so sweet of you to say that you're enjoying the book on the VPA and about candlestick charting. I don't pretend in the book that I am, you know, that there is everything that's ever been written about candlesticks in the books that are up on Amazon. And there's you know, it's a very, very old charting system. I don't know how many years has it been going, from the rice traders in Japan, isn't it? Yeah. It's fascinating. If you do want to know a little bit more, there are a couple of people out there. There's obviously Steve Nyson, or Neeson, however he pronounces his name, but there's also a guy called Bukowski. Can't remember his first name. What's Stefan? Stefan Bukowski. You sure that's Stefan? That's not the guy. Stefan Bukowski? Bukowski. While David's on, I'll look and put the link up. But basically, what he's done, he's taken all the kind of various candle combinations. I mean, he's done a fantastic analysis on it, and actually give a kind of percentage of when they are when they're likely to you know, to be valid, as it were. But he just uses price action. This is what I'm saying. This is what I'm saying earlier. It is a fantastic piece of analysis that he's done. He's got some free stuff on his site, and he's got some books up on Amazon as well. But I go right back, and it's a great question from that they've had about candlesticks, is if you actually put them together with volume, then I think the, you know, whatever percentage he has on this works out basically how successful they are as for reversals and what have you. I think you will be able to take from that if you add the volume to it and you analyze them together with volume, you're going to be you're going to have a higher probability, as it were, that they're actually going to play out as they are going to play out. You also have to remember that you know, a lot of traders who use volume don't actually use candlesticks; they use bars. In fact, when we started, I think they tried to put us onto bars, didn't they? Price bars, and we found them. And the thing with bars is, they don't really consider the wicks. The wicks of the candles are really, really important. So as I said, but Bukowski, I'll go and have a look at I'm going to have a look at how you spell his name, and I'll put it in the chat box. And Jeff says, can we give you a stock to look at? Yeah, AMED. I love your material. I'm not sure if you look. Yeah, fine, Jeff. I mean, we've just chosen them from our own criteria. If you've got something that you want us to have a look at, why not? I mean, we don't have a problem with that. As I said, yeah, AMED, and I'll leave that to David, and I'll go and have a look at Bukowski.
Certainly do that one for you, Jeff. No problem at all. I'll try to rattle through these fairly quickly, if I may. I just wanted to pull this one up because it's related to the oil market. And again, it just reinforces the fact that whatever it is you're trading, it's an understanding of related markets. In this case, it's a direct relationship, obviously, to the price of oil. I think this is a services company, but certainly associated to commodities at any rate. And again, it just reinforces that relationship that, you know, whether you're trading in stocks or whatever it is, you've got to be aware of what is likely to impact that particular market you're trading. Going back to my answer to, I forget who it was that asked the question now. Was it Jeff, I think? On the when I was explaining about getting in a re-entry, there's two things. First of all, this is the sort of candle you're looking at. You're looking for, on this occasion, not a lot of volume associated with it, but you're looking for decent volume. We do get some buying coming in here. This is quite interesting. You've got decent volume under that candle. When you see that sort of wick to the downside, then you are at the least expecting some sort of pause point. This is, you know, we're getting into Thanksgiving territory here. But again, it's this sort of candle where you see, and you've got a rising market, you've got two candles, but the volume is falling away. And then you get a third candle here where you get decent volume under it, but the price action is very narrow. You've got a wick to the upside. We're hitting some resistance. We've got a ton of price resistance over here anyhow, but you've also got decent volume under here, and the price action is narrow. So what's happening here? This is basically selling. The market makers, the insiders, the big operators, whatever it may be, they are selling into a weak market. This market is not strong, it's weak. And the effort that is going in here has not resulted in the price action closing where it should have done, because if you compare this to other candles, given that sort of volume here, as opposed to, let's say, here, for example, or this candle, for example, which is probably a better example, that price action indicates that it is associated, generally all things being equal, with that amount of volume. Over here, you've got the same amount of volume, but you've actually got half the price action. It hasn't gone anywhere. So in other words, the wheels are spinning, there's effort going in, and it's not being reflected in the result. And, you know, down we go again. Is this looking weak? You betcha. You know, more selling volume coming in here. This is looking pretty weedy. You'd be up onto the weekly chart, or maybe as an intraday, but certainly on the week, if you're looking at this as a longer term investment to short this particular market. Absolute heap of volume over here that is compressing this market further. And it's just reflected in the price of oil. Let me put in that one. What was it again?
Did you say that was oil and exploration company?
Yes. Yes. Sorry, I was just being told off. Anna said, "Did I tell them it was an oil and exploration?" Yeah, it's oil. Is it oil services or exploration? Oil and gas. So, you know, it's a relatively direct relationship with oil. Then that's not to say that when oil prices start to rise, then this company's share price will rise. You know, it's not that simple. Then you'll be looking at the fundamentals of the company. You'll be looking at the volume profiles. Maybe you look at, you know, things like PE ratios, return on investment, whatever it may be. Earnings will have a huge impact. You know, a good earnings result would make the price rocket. Equally, a weak result would make it fall very quickly. So it's understanding all of those relationships. And of course, the other impact would be the sector. You'd be looking at the sector analysis for this. Because it's a commodity stock, you'd be looking at the sectors for other commodities. You'd also be looking at the commodity index and all those other factors that play out. Let me just use this chart to flick over onto, what was it? Yep. AMED. Sorry, I'm being told off because we've gone on too long. Apologies. There we go. I have no idea what this company does, but I'll tell you what the chart's telling me at the moment. And certainly from a daily perspective, if you're looking at this from an investment, and I'm assuming that you'd be looking at it to buy, I wouldn't be buying it right now for 26 different reasons, but not least of all the fact that we are trading around the volume point of control, which is here at 121 odd. Lots of volume there. We've been in congestion since, gosh, when does this go back to? Where are we? This is August. So, you know, we've been in decent congestion now for some time. It's pretty volatile. This was probably earnings or something in here because we had this big spike on decent volume. The other thing also that I find slightly worrying right now is that we've got this amount of volume with this amount of price. So this suggests a certain amount of weakness. We've had a 2-bar reversal. Market's gone to the downside. Bear in mind, sorry? Yeah, we've got Thanksgiving here, but you know, if you were seeing that under normal circumstances, you'd be running a mile. Don't like that at all. But we've got the volume point of control here, and we've got, now from a positive perspective, we've got a heap of potential support below in the 116, 117 area in this region here. So potentially, there is support in place if the market reverses, which is likely to remain in congestion here for some time. Trend monitor's bright blue, so that's positive to, move to the upside. If I was looking at this as an investment opportunity, then I'd obviously be looking at it at the weekly, and certainly just looking at the daily chart. If we get a breakthrough the 128 area, for example, that is the point that I might look to, or maybe 129 to give me a bit of comfort maybe. If the market gets to 129 on decent volume, then I would look at that as a potential opportunity for a breakaway to the upside. Equally, it might break to the downside, but if I'm looking at it from a longer term investment perspective, then that's the sort of thing I would be looking at. I'll just have it on a watch list. It's in congestion, and I'd wait for it to break to 128, 129, and then look to take it thereafter. That's not investment advice, I have to say. Very narrow candle on a lot of volume. I mean, all that's telling you, yesterday's candle it's telling you it's indecision. You've got lots of volume there. It's a doji candle, not going anywhere. It's just reinforcing the fact that you're in congestion, and that particular stock is not going anywhere. What's interesting about it, though, having said all that, is this: that we're seeing it in some ways reflect what is going on in the primary indices, and again, it doesn't automatically mean if indices rise or stocks rise, because as you've seen on the chart, you've got GE, which is relentlessly falling despite what the primary indices do. But some stocks will follow the index quite closely, others will go in a completely opposite direction for lots of different reasons. Again, it's back to understanding, you'd be looking at the sector for this particular stock, you'd be looking at the primary indices, you'd be looking at the volume profiles and everything else, all the multiple timeframes to go along with it, and whether that is an opportunity to take in the future. I'm going to pass back to Anna because we've gone way over time. Apologies for that, and thank you for your patience as well.
Thank you. Listen, we really didn't intend to go over so much today, and we are planning to perhaps put more on, but make them a lot shorter. It's not so much the actual live stuff is fine. It's just the replay time. People just don't have the time, and it's actually quite difficult with this recording to chop it up into small bits. Anyway, thank you so much for sticking around with us, and as I said, we really hope you've enjoyed what we've been covering, and that if you've not used volume price analysis before, not something you've come across before, at least give it a try. You can just pick up the book on Amazon for, I think, $4.99, but as David said, there's a whole bunch of bundles that we've put together where it's just a bundle. It's just bundles of the book. It's a box set. That's what I'm trying to say. They're box sets. Yes, we've created box sets, but only of the digital versions of the book. They're called box sets, but they're still digital versions, and they're going to be going up on Amazon in the next sort of few days. With regard to the indicators that we've been using, the volume point of control, the accumulation and distribution, the volatility, it's actually part of a set of 9 tools and indicators for NinjaTrader. The total cost of the package is $749, which you can pay outright, or we offer 3 easy monthly payments. You don't have to buy the whole package. You can just buy one indicator, and I suppose the indicator that we will always say start with is something like the volatility indicator, because oh boy, if you understand, we'll talk about volatility on another occasion and how you can play it and make it your friend and not your greatest enemy. But you can find details of all the indicators at the main site, which is, here we are, quantumtrading.com. This is the for NinjaTrader, and it's got the whole, there's the videos, support pages, etc. There's also a YouTube channel called Quantum Trading, and there are very short videos to explain how each indicator was developed and how you can possibly use it in your own trading. But if you want more information from either of us, you can either you can drop helpdesk@quantumtrading.com. The guys there are always happy to help both existing customers or any inquiries, or you can email David at Quantum Trading, or you can email me, Anna, at annacooley.com. So brilliant. All I can say is thank you so much. Yes, the replays will go up on my YouTube channel and the Quantum Trading YouTube channel. In fact, I'm going to redo the slides with the links on there. You can go straight there, and they'll be up in the recording will be up in a few hours' time. We are back tomorrow for Forex, slightly later. I'm you know, in the run up to Christmas, I can't cope with these early mornings. So we're back at what, 10:15? I believe so. 10:15. It's much more, much suits me much more. But anyway, I know some of you will be coming along to that one, so we will welcome you then. Again, that'll be recorded. It's just Forex tomorrow with MT5 and NinjaTrader. Thank you so much. And Chugai, thank you so much. The books are awesome. Brilliant. Enjoy the rest of the day. If we don't see you tomorrow, we'll catch you next time. Bye.